Hello and welcome to this session in which we will discuss estimated tax payments for C Corporation. And we will be approaching this topic from a tax strategy tool. We have three tools of tax strategy. We have timing of income. When do we recognize the income or the expenses? We have the shifting, and we talked about those concepts in the prior session. In this session, we will focus on estimated tax payment as a strategy tool. Now, the first thing we want to know is, why do corporations make estimated tax payments? Well, simply put, they have to pay their taxes. And unlike an employee, if you work for a company, you don't have to make estimated tax payment because the company that you work for withhold this money from your paycheck. But a corporation is the employer themselves. No one's going to withhold money for the corporation. The corporation will have to pay the money to the U.S. government. So they pay the money to the U.S. government because they need to comply with the laws. You need to pay your taxes. The most important is you want to avoid penalties for underpayments. And this is what we will be focusing on. How can you avoid penalties for underpayment? In other words, pay the amount that is going to avoid charging you penalties or interest. Also, you want to make sure what's your tax bill, because for managing your cash flow, you want to know what is your tax bill. And this way you can implement an effective tax planning strategy. So these payments, make sure do two things. You are in compliance with regulatory compliance of the IRS, and make sure you have enough cash because you are looking ahead, knowing how much you are responsible for. So effective corporate tax planning involves strategies aimed at what? Overall, reducing your tax burden. Why? Because you want to keep as much money as possible. You don't want to pay penalties. You don't want to pay interest for underpayment of taxes. And in this session, we will discuss what are the tools, the strategies, the availability, the options for a C corporation that they need to explore in order to do what? Comply and pay the minimum amount of taxes. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
The first thing we are going to discuss is dates, because you need to be familiar with the date. The tax return deadline for a C corporation is 3.5 months post their fiscal year end. So if you're a calendar year, December 31st, that'll be April 15th. Otherwise, 3.5 months. However, corporation can apply for an automatic 6-month extension which extend filing the deadline, but not the payment. So if you do file for an extension, you are allowed to do so. That's fine. They're going to give you 6 additional months. However, you still have to make the payment. So you make the payment when you file the extension. So a C corporation must still make estimate payment and pay any taxes owed by the original due date when requesting an extension. So the extension is only to put the numbers together. They're giving you more time to put your numbers together, but you have to make the payment. Now you're saying, what happened? I don't know what my numbers are. How do I make a payment? Make a payment, and guess what? Have some extra. This way you don't charge underpayment of penalties. So for a corporation on a calendar year basis, April 15th is 3.5 months after its year end, with an extension 6 months, which will be October the 15th. Now, assuming these dates fall on a weekend or a federal holiday, the deadline shifts to the subsequent business day. On the next slide, we're going to look at important payment due date. So C corporation must make estimated tax payment unless their tax liability for the whole year is under $500. Otherwise, you have to make estimated tax payment. The first thing we're going to look at is when. When do you make those payments? This is important. The first payment, the first installment, has to be made April 15th. Now, what's special about April 15th? It's 3.5 months after assuming a calendar year, 3.5 months after your calendar year. It means the first quarter, the 3 month, has already passed. Let's take a look at the second installment payment. The second installment payment is due June 15th. Hold on a second. If we're using the same logic, it should be July 15th, and the answer is no. The second installment payment will be, and you're going to see why those dates will be a little bit important later on. June 15, 15 days before end of second quarter. And just make a note of this. You're going to see why this is important. So for the first payment, let's go back to the first payment. With the first payment, you have to make 25% of the total tax due. Now, how do you compute this 25%? We'll look at that shortly. The second installment, as I mentioned, it has to be made 15 days before the second quarter ended. And here you have to pay an additional 25%. So by the second installment payment, 25 plus 25, you have paid 50% of your tax bill. The third installment payment is due September 15th. Again, what's special about September 15th? It's 15 days before end of quarter, end of the third quarter. And here you have to pay an additional 25%, and in total you should have paid 75% of your tax bill. The fourth installment payment is due December 15th. Again, what's special about this? I know I'll keep repeating this. You're going to see why this is important later. It's 15 days before the end of the quarter. You'll pay the last 25%. That at this point you would have paid 100% of your taxes. Now, I showed you the date and the percentage. Now we need to figure out, how do you figure out the dollar amount? So you can take the dollar amount times the percentage. So the calculation of this annual requirement payment, which is 25% per quarter, can be based on one of the following 3 criteria, chosen to do what? Minimize the payment amount. So you could choose 3 methods to do what? If you follow those 3 methods, assuming you follow them properly, you will avoid the penalties. And that's what you want to do. You want to avoid underpayment and penalties. The first method is this. You want to pay your current tax liability. Here, the corporation can opt to pay 100% of the estimated tax liability for the year. Well, that's great. But what do you have to know here? You have to know what's your tax liability. It means you have to have good estimate. It means from a business perspective, you know exactly how much you are going to own. This method involved estimating the total tax for the current year and making quarterly payment that sum up to that estimate. And this works for corporations that have steady income, because you know exactly how much income you are going to receive. And estimated tax payments are often based on the current estimated tax liability, dividing it equally over 4 quarterly estimates. If that's the case, if your income is stable and you know your income is not going to change, you can estimate your income for the next 4 quarters. No worries, you'll pay your current year tax liability, 100% of it, and you are good to go. That's one way to do it. Another way to avoid penalties is pay prior year tax liability. Well, but there are certain caveats to this. This option allows the corporation to base its quarterly payment on 100% of the tax liability reported on the prior year tax return. So simply put, if your prior year tax are $1 million, you would say my tax bill was $1 million. I'm gonna divide by 4, and every quarter I'll pay $250. Is this allowed? Yes. However, this method, okay, can only be allowed for the first quarter. This can only be allowed for the first quarter payment by large corporation. So if you're a large corporation, yes, you can take this $1 million and divide it by 4, and you said my tax bill is $250,000 for the first quarter. But if you're a large corporation, you can only do this. It means, what's a large corporation? With $1 million in taxable income in any of the 3 preceding years. If you are a large corporation, you could use this only for the first quarter. And it cannot be used, you cannot use this method at all if corporation has no tax liability. It means in the prior year you have an NOL. So if in the prior year you have NOL, you would say, well, I don't have to pay taxes because I'm basing it on the prior year. You can't do that. So if you have NOL, you cannot use it. And if you have less than $1 million, you can use it. If you have more than $1 million in taxable income, you could use it for the first quarter. Now, those are the 2 methods. Current year tax liability, you can estimate, you're good to go. Prior year tax liability, you can use always for the first quarter, regardless of how big you are. But once you are large enough, you cannot use it other than the first quarter if you are a large company with over $1 million in taxable income. What is the third method? This third method is called annualized income method. What I'm going to do with the annualized income method, I'm going to be discuss it in a separate recording to be discussed. So I'm going to have one recording called annualized income method because I believe it merits a little bit more of explanation. This way I will give it the enough time so you can understand it. But the best way to illustrate those two methods, the current year tax liability and the prior year tax liability, is to do what? Work in example. XYZ Corporation, it's a calendar year C corporation, is basing its estimated tax installment payment. Taxable income from the previous year is $600,000. Taxable income for the current year projected to be $900,000. The federal income tax return is 21%. How can they make their payment? Well, if the federal rate is 21%, if they use the tax liability based on the prior year income, they're going to take $600,000 times 21%. Their tax bill is $126,000, and we're going to divide this by 4, and it's going to be $31,500. The estimated tax liability based on the current year projected income, $900,000 times 21%, that's going to give them $189,000. We'll divide this by 4 months, and that's going to give them $47,250. From a tax planning perspective, what would you pay? Will you rather pay $31,000 or $47,250 as a quarterly payment? Well, obviously, from a tax planning, you might choose to pay the lower quarterly payment to avoid any underpayment of penalties because you're in compliance. Whether you pay $31,500 or $47,250, you're in compliance. You avoid underpayment of penalties. Why? Because you're less than $1 million. You could use both of these methods are acceptable. However, keep in mind that if you pay $31,500 rather than paying the full amount, at the end of the year, you are still responsible for the $63,000 for the total tax, the difference between the two. And this could be a large tax payment that could what? That could sap you out of your cash, could disrupt your operation if you don't adequately plan for it. Therefore, you want to make sure, yes, if I pay $31,500, am I going to be able to pay the difference with my tax return? Otherwise, let me pay $47,250 quarterly. This way, I make sure I have the money and I am not caught short at the end of the year. So this example illustrates the two methods that I discussed here on this slide, the current year tax liability versus the prior year. In the next session, what I would do is look at the annualized income method. Again, as I mentioned, the annualized income method worth one whole session. What should you do now? Go to Farhat Lectures, look at multiple choice, additional resources that's going to help you, whether you're studying for your CPA exam or you're studying for your accounting courses. Good luck, study hard, invest in yourself, and of course, stay safe.